Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Cheniere Energy stock by analyzing their financial statements and dissecting their financial ratio so we can determine if it's a buy or a sell. Cheniere Energy is a liquefied natural gas company, hence the ticker LNG. In 2016, it became the first US company to export liquefied natural gas. In that same year, the founder Sharif Suki was ousted after a dispute with investor Carl Icahn. In the late 2010s, as natural gas production rose in the US, this company grew significantly. LNG is produced by purifying natural gas and cooling it to negative 260 degrees Fahrenheit to turn it into liquid. This also makes it easier to transport natural gas as well. The company is headquartered in Houston, Texas, and was founded in 1996. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, and London Stock Exchange. Let's get started with the model. This is a large cap company, 34 billion market cap. They're trading at $133 a share, and they have 254 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 2019 and 2020. It was 1.5 billion in 2021. Then it doubled to over 3 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's positive in 2019 and 2020, negative in 2021 and the trailing 12 months. Revenue is a sales for the company, and that's more than double from 9.7 billion to over 20 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Their cost of revenue is getting really high. This is something you should definitely look into because they have negative gross profit in the trailing 12 months. But this is mainly due to non-cash items because we'll see in the statement of cash flows they're generating more cash than ever. Below gross profit is their operating expenses. These are all the expenses not directly related to generating the revenue, such as marketing and R&D. Gross profit minus operating expenses gives you your operating income. It looked good in 2019 and 2020. It's negative in 2021 and the trailing 12 months. They spent 1.4 billion of interest on their debt, which is a little lower than 2020, the same as 2019. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is negative in 2021 and the trailing 12 months, positive in 2019 and 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Operating cash flow eliminates the accounting items on the income statement. So they actually generated over 4 billion of cash flow in the trailing 12 months. They may have done a lot of write-downs in the trailing 12 months, or maybe they paid a lot in stock-based compensation. That's a non-cash item that brings down your net income, but it doesn't affect cash flow. Then you have CapEx, investments in property, plant, and equipment. They need to build out a lot of LNG infrastructure, and the cost of that goes into CapEx. They spent a lot in 2019 and 2020. They cut their spending down in 2021 and the trailing 12 months. But it seems like the investment in CapEx paid off because even though they had negative free cash flow in 2019 and 2020, it was a big positive in 2021 and the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. They also started paying a dividend, and they paid down about 900 million of debt in 2021. They added 900 million in 2020. And they added 2 billion in 2019. Let's look at the capital structure. Negative 3.7 billion of equity. This means their liabilities are 3.7 billion more than their assets, and 31 billion of debt. So they're 0% equity, 100% debt. Their net debt is 28.5 billion, and their WACC on Finbox ranges from 8.3% to 10%. I use the middle one of 9.3%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which saw cash flows past year 4, that's 33 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $32 billion. We divide that by 254 million shares. And we get a calculated stock price of 126. They're trading at 133, so they're trading at a 5% premium. It's a sell according to the model. Their revenue target for 2024 is $19.5 billion. For 2023, it's $21.8 billion, and for 2022, it's $25.6 billion. I continued this trend into 2025 and I got $17.3 billion. That's how I got their future revenue estimates. They convert 13% of their revenue into free cash flow in 2021 and the trailing 12 months. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. If you go to the website Simply Wall Street, their valuation is 116. They're saying the stock is also overvalued. They're saying it's 15% overvalued. 9 analysts priced this stock and the average price target is 171, the low is 158, the high is 193. This is where the stock has been trading the last 5 years. Before COVID, it was under $75 a share. Then when COVID hit, it looks like it fell to about $30, $35 at the low. But ever since that low, it's been a rocket ship, hitting $150. It has come back down a little to 127, but it's still trading way above its pre-COVID levels. This bottom chart is the price of LNG for the past 5 years. There's some similarities, but I wouldn't say it's too correlated. This bottom chart is the price of natural gas for the past 5 years. And I would say this chart is much more correlated to LNG stock price. So the best way to predict this company's stock price is to track the price of natural gas. They just started paying a dividend a few months ago in November. They pay 33 cents a share. It's a quarterly dividend. It's a yield of 1%, which they can easily afford, and I'm sure they're going to raise it because it's only 11% of their free cash flow. And it looks like the forecast is for their yield to stay around 1%. Because the forecast is between 1 and 1.2% for the next 3 years. The last time they did a stock split was 17 years ago in 2005, a 2-for-1. Before that, they did a reverse stock split of 1-for-4. The company was struggling for a while, so the stock price probably got below $1. So they did a 1-for-4 reverse stock split. They have a beta of 1.2, so the stock is a little more volatile than the market. It's gone up 52% in the past 52 weeks, while the S&P is down 13%. The 52-week low is 80, the high is 150. And the stock is trading between its 50-day and 200-day moving average. 3 million shares are traded each day on this stock. Of the 254 million shares outstanding, 243 million are on float, 90% are held by institutions, and 1.3% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd be really happy at $87,000 today. That's a 770% return, a 24% annual return. The CEO's annual salary is $1.5 million, and their total compensation package is $18 million. It was a little lower in 2017, but it was higher in 2019. In the past 12 months, there's been only insider selling, no buying. Carl Icahn's company sold 2.7 million shares and 1.3 million shares. Then 2 other people at the company sold. 88% of the company is held by institutions, 11% by the general public, and 0.6% by insiders. Their employee count went up a lot from 2017 to 2020. They currently have 1,600 people on staff. The biggest shareholder is Vanguard at 8%, then BlackRock, Fidelity, Icahn Capital, Abu Dhabi, Harvest Fund, Manulife, State Street, American Century, and Reef America. The parent company of Reef is Deutsche Bank. The best way to look at ratios to compare them to companies in the same industry. There are 59 companies in the same industry as Cheniere, and if Cheniere has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend twice as much as average in CapEx. We can't look at their debt to equity ratio since they have negative equity. They pay a really small dividend, smallest on this list. They do generate lots of free cash flow, over $3 billion, average is $870 million. They rank 6th in market cap at $34 billion, the average is $9 billion. We can't look at their price to book and price to earnings since they have negative equity. They have a better price to free cash flow and price to sales than the average company. They generate lots of revenue, and the reason their stock price is going up so much is because look how much their revenue is growing, 53% on average the past 5 years. They have negative net income, so they have a negative ROA. We cannot look at the ROE. ROE is net income over equity, and both those numbers are negative. So to summarize, I have them trading at a 5% premium. And this company really fills a void because LNG and natural gas are a great supplement to oil. And that's why the stock has been doing so well. And it seems like for this year, next year, and possibly longer, oil and gas is highly, highly needed. Even more so than before with all the conflicts going on, plus inflation. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.